Good afternoon. Since the previous meeting of the Monetary Policy Committee, the inflation outlook has deteriorated significantly, mainly due to exchange rate and food price developments. The rand has depreciated considerably in response to domestic and external developments, while the impact of the worsening drought on food prices is becoming increasingly evident. The outlook is complicated by the fact that the domestic growth outlook has weakened further. The global backdrop has also become more challenging, particularly for emerging markets, and downside risks to the sustainability of the recovery in the advanced economies have increased. The year-on-year inflation rate, as measured by the Consumer Price Index, CPI, for all urban areas measured 5.2% in December, up from 4.8% in November. The increase was broadly in line with market and the bank's expectations, and reflected in part the delayed response of food price inflation to the impact of the drought on agricultural prices. Food and non-alcoholic beverages inflation accelerated to 5.9%, up from 4.8% previously, and contributed 0.9 percentage points to the overall CPI outcome. Goods price inflation increased to 4.6% from 3.8% previously, mainly due to higher petrol and food prices, while services price inflation remained unchanged at 5.7%. The bank's measure of core inflation, which excludes food, fuel, and electricity, remained relatively stable at 5.2%, up from 5.1% in November. Producer price inflation for final manufactured goods increased from 4.3% in November to 4.8% in December. The category of food, beverages, and tobacco products contributed 2.1 percentage points to the December outcome. The latest inflation forecast of the bank shows a marked deterioration. Having averaged 4.6% in 2015, inflation is now expected to average 6.8% in 2016 and 7.0% in 2017. This compares with the previous forecast of 6.0% and 5.8% for these years. Inflation is still expected to breach the upper end of the target in the first quarter of 2016, but is now expected to remain outside the target for the entire forecast period. A peak of 7.8% is expected in the fourth quarter of 2016 and the first quarter of 2017, followed by a moderation to 6.2% in the final quarter of that year. The previous figure was 5.7%. The changes in the forecast are mainly due to a significantly more depreciated real exchange rate assumption and higher expected food price inflation. These upward revisions more than offset the impact of the lower international oil price assumption. The electricity price assumption remains unchanged from the previous meeting. The forecast for core inflation has also deteriorated, although to a lesser degree than that for headline inflation. Core inflation is expected to breach the upper end of the target range for 4 consecutive quarters from the third quarter of 2016, with a peak of 6.4% in the final quarter of 2016 and the first quarter of 2017. This measure is expected to average 6.0% in 2016 and 5.9% in 2017, and to moderate to 5.5% by the final quarter of next year. The deterioration in the forecast is mainly due to the more depreciated exchange rate assumption and expected higher unit labor costs. Inflation expectations are reflected in the survey conducted by the Bureau for Economic Research, show a marginal upward movement for 2016, but a more pronounced deterioration for 2017, with average inflation expectations increasing from 5.9% to 6.2%, mainly due to the changes in the expectations of trade union officials. 5-year inflation expectations edged up to 6.1%, also mainly due to changes in the expectations of trade unions. The survey was concluded prior to the depreciation of the rand in December, so the outcome of the next survey will be closely monitored. The impact of the rand exchange rate weakness on market forecasts is evident in the changes to the Reuters Econometer survey between December and January. Median inflation expectations were stable in November and December at 5.9% and 5.8% for 2016 and 2017, but increased in January to 6.0% and 6.1%. The median forecast for 2018 is 5.7%. Break-even inflation rates also increased significantly across all maturities, with the 5-year maturities rising to current levels of around 7.3%. The global growth outlook appears to have worsened somewhat in recent weeks, contributing to a correction in global equity markets. Although most of the downward revisions to global growth have been due to the deteriorating prognosis for emerging markets, more recently, the risks of a slowdown in the US have increased amid declining consumer expenditure and the impact of low oil prices and a strengthening dollar on business investment. However, despite the fourth quarter slowdown, growth of around trend is still generally expected. While the recovery in the euro area remains modest, the growth forecasts for the UK and Japan have generally been revised down. Emerging market growth prospects, particularly for commodity-producing countries, remained constrained amidst persistent capital outflows. The outlook is heavily influenced by the slowing Chinese economy, but there are conflicting views as to whether a hard landing can be expected. There is also uncertainty regarding the efficacy of policy reforms that have been undertaken. Perceptions of the modifications to the renminbi exchange rate regime, as well as equity market volatility, have added to this uncertainty. Global inflation pressures remain benign, reinforced by a further decline in international oil prices, but there have been upward revisions in some emerging markets. Monetary policies in most advanced economies are expected to remain accommodative. The slow pace of normalization in the US is expected to continue, but further easing is expected in Japan and the euro area, while the Bank of England has indicated that monetary policy tightening is still some way off. Divergent monetary policy paths are also expected in the emerging markets. Commodity importers with sound macroeconomic fundamentals have scope for further easing, while some commodity producers, particularly those experiencing exchange rate-induced inflationary pressures, have been in a tightening mode despite slowing growth. The exchange rate of the rand depreciated markedly since the previous meeting of the MPC, contributing significantly to the deterioration in the inflation forecast. Since the previous meeting, the rand has depreciated by 13.5% against the US dollar, by 15.2% against the euro, and by 12.9% on a trade-weighted basis. The muted reaction of the exchange rate to the start of the US Fed normalization suggested that this move was more or less priced in, but this was overshadowed by the impact of domestic developments on the exchange rate earlier in the month. In early January, the rand reacted further to growing concerns about the outlook for the Chinese economy. While most emerging market currencies were affected, since the previous meeting of the MPC, the rand's depreciation has been in excess of most of its emerging market peers. Other indicators such as widening credit spreads and the sharp increase in domestic bond yields point to a higher risk premium attached to South African assets. Although at current levels the rand may appear to be undervalued, divergences from the equilibrium can persist for some time. Furthermore, the current account adjustment remains slow, with the deficit expected to widen further in the face of continued weakness in commodity prices and higher drought-induced agricultural imports. The financing of the deficit will also be more challenging in an environment of persistent capital outflows from emerging markets. Since the previous meeting, non-residents have been net sellers of South African bonds and equities. From a monetary policy perspective, a key risk to the inflation outlook is not only the possibility of further deterioration, but also the extent to which there is a change in the pass-through dynamics, which have been relatively muted in recent years. The domestic economic outlook remains weak, with further downward revisions to the bank's forecast. Growth in 2015 is estimated to have averaged around 1.3% and is expected to moderate to 0.9% in 2016 before accelerating to 1.6% in 2017. This compares with the forecast of 1.5% and 2.1% for 2016 and 2017. The bank's estimate of potential growth was revised down from 1.9% to 1.5% for 2016 and from 2.1% to 1.6% for 2017. Although there was a marginal increase in the bank's leading business cycle indicator in November, the trend remains negative, consistent with the subdued outlook. The RMB BER Business Confidence Index declined further in the fourth quarter of 2015 to its lowest level in 5 years. High-frequency data indicate that mining sector remains under pressure in the face of declining commodity prices and weak demand. Despite a recovery in the third quarter, the manufacturing sector remains negative. Capacity utilization has declined further, and the Barclays PMI, which has remained well below the neutral level for some months, is consistent with a contraction in the fourth quarter. The continuing drought also means that near-term respite for the agricultural sector is unlikely. Underlying this growth outlook is the continued low growth in gross fixed capital formation, with private sector investment contracting in the third quarter. The prospects for formal sector employment growth, therefore, remains bleak. The quarterly employment statistics survey of Statistics South Africa reports static employment levels over the 4 quarters to the third quarter of 2015. Growth in consumption expenditure by households also moderated in the third quarter, with contractions in spending on durable and non-durable goods. Domestic motor vehicle sales reflected this weakness, although recent retail sales data, particularly with respect to semi-durable goods, suggest there may have been a modest improvement in the final quarter of last year. However, The decline in the FNB-BER Consumer Confidence Index in the fourth quarter of 2015 to a 14-year low suggests that household consumption expenditure is likely to remain constrained. Credit extension to households has increased marginally recently, particularly with respect to mortgage and general loans. However, these increases remain low and negative in real terms, while installment sale credit continues to slow. Tighter National Credit Act regulations related to the affordability assessments became effective from September and are expected to constrain credit to households further. While credit extension to corporates remains robust, it is relatively narrow-based and reflects in part increased demand for mortgage loans by property funds. Wage and salary trends continue to contribute to the persistence of inflation at higher levels. Year-on-year growth in nominal salaries and wages, while lower in the third quarter of last year, was still above the upper end of the inflation target range. After adjusting for labor productivity increases, growth in total unit labor costs slowed marginally to 5.0% in the third quarter. Andrew Levy employment publications reported an average wage settlement rate in collective bargaining agreements of 7.7% in 2015. Food prices remain a significant risk to the inflation outlook. The surge in agricultural commodity prices since early 2015 is beginning to impact on consumer food price inflation, and these pressures are likely to increase in the light of the persistent drought and the weaker exchange rate. This is despite continued moderation in global food prices. Although previous forecasts had incorporated an expectation of higher food price inflation, recent adverse developments have resulted in a further deterioration of the bank's food price forecast, which is now expected to be at around 11% in the fourth quarter of this year. International oil prices have declined to multi-year lows since the previous MPC meeting. The global oversupply and consequent low prices are expected to persist in the short term, particularly following the lifting of sanctions against Iran. But with marginal producers expected to shut down or reduce production, prices are expected to upward trend over the forecast period. The impact of this upward trend on domestic petrol prices had contributed to the higher inflation forecast in 2017 in particular. The potentially favorable impact of the international oil price decline in domestic petrol prices has been more or less offset by the depreciation of the rand. Petrol prices have declined only marginally since November, and the current under-recovery suggests a possible increase of around 7 cents per litre in February. Previously, the committee expressed concerns about the growing risks to the inflation outlook, mainly due to exchange rate and food price risks. These risks appear to be materializing and have contributed to the significant deterioration of the inflation forecast. The intensity of the drought has brought about a sizable revision to the bank's food price outlook, while the exchange rate has depreciated significantly more than expected. While oil prices have a moderating impact on the inflation outlook in the near term, base effects and the assumed upward trajectory contribute to the adverse inflation outlook in 2017. The forecast also incorporates changes in administered prices, in particular for water, while an upside risk remains regarding electricity tariff increases. The MPC assesses the risks to the inflation outlook to be relatively balanced. While there may be potential for further rand weakness in the short term, given the negative outlook for emerging markets in general, as well as domestic factors, the lower observed exchange rate pass-through remains a mitigating factor. However, there is still uncertainty as to the sustainability of this low pass-through, particularly in the face of large nominal exchange rate movements as recently expected. The upside risk from the exchange rate is more or less offset by the downside risks from the international oil price assumptions and projected food price inflation. Demand pressures remain constrained, and the focus of the MPC will therefore be on the evolution of inflation expectations and indications of second-round effects of the exogenous shocks to the inflation outlook. There are some indications that inflation expectations may have deteriorated, but the extent of this will become more evident in the coming surveys. The trend in core inflation provides some indication of the possible emergence of second-round effects. Although core inflation has remained relatively contained in recent months, it is expected to accelerate and to exceed the upper end of the inflation target range for some time in response to exchange rate and wage pressures. The committee faced the continuing dilemma of a deteriorating inflation environment and a worsening growth outlook. The risks to the growth outlook are assessed to be on the downside, despite the downward revision to the forecast. Given the deterioration in the inflation outlook, the MPC decided to increase the repurchase rate by 50 basis points to 6.75% per annum, effective from the 29th of January 2016. 3 members supported a 50 basis point increase. 2 members preferred a 25 basis point increase, whilst 1 member preferred no change. The MPC still views the stance of monetary policy to be accommodative. Despite the rate increase, the real repurchase rate remains low given the higher expected inflation over the period. The MPC will remain focused on its core mandate of containing inflation within a flexible inflation targeting framework. As noted on a number of occasions in the past, the MPC is of the view that the growth constraints facing the economy are primarily of a structural nature and cannot be solved solely by monetary policy. Nevertheless, the MPC remains sensitive to the extent possible to the possible negative impact of monetary policy actions on cyclical growth. As before, future moves will be highly data dependent. That concludes our statement, and at this stage, I would like to invite any questions that you might have, and as usual, identify yourself and the media house that you represent, and my colleagues and I here will see how we deal with your questions. Ma'am, in a green top.
Thanks, Governor. Hi, it's Hannah Zaidi from MoneyWeb. My question is just around, and perhaps the bank can give a little bit of color as to which drivers of inflation you believe are particularly sensitive to changes to the interest rate and which are insensitive, because if the bigger drivers of inflation are insensitive to interest rate hikes, such as potentially state-administered prices, then that obviously begs the question, are interest rate hikes effective in containing inflation? Thank you.
What other tool do we have? Ma'am?
Thank you, Governor. It's Mariam Issa from the Sunday Times. Do you have any sort of idea or estimates as to how much the drought is going to subtract from GDP growth this year? And is there any chance at all that the economy could slip into a technical recession given the impact of this drought, as well as other matters?
Yes, ma'am.
Good afternoon, Governor Ntakisi from Business Day. Last year, the bank said they were on a moderate rate hiking cycle. Has this changed? Has the rate hike played any role in your downward revision of GDP? Thank you.
Yes, yes, ma'am.
Thank you, Governor. It's Renee Volgraaf from Bloomberg News. Governor, you said 3 of the MPC members favoured a 50 basis point hike and 2 25 and 1 favoured no change. So essentially, I mean, 3 members said 50 and 3 members did not say 50. Why did you not go for a 25 basis point hike then? You did say recently in Davos that at the current level of the repurchase rate, 25 is not insignificant.
Last one in this round.
Patrick McGroarty from the Wall Street Journal. You talked about the international pressures on the economy, on the rand, and also domestic factors. Are you frustrated in the way local political leaders, President Zuma, have handled the pressure on the economy and the impact that had on global sentiment in December, particularly around the replacement of the finance minister?
Okay, let me see what I deal with here. Rashad, you are going to say which drivers are sensitive to interest rate hikes and whether interest rates are effective dealing with inflation. Since you used to be an academic, I don't know of any other instruments at the disposal of the bank to deal with inflation, but since you can deal with that, and I will also ask you to deal with the impact of drought and whether there is a possibility of going into a recession. Let me deal with the rest of the questions. Ntakisi, the bank, you say that the bank said that it was on a moderate hiking cycle last year. We didn't say so. We said we are on a hiking cycle. The role of the interest rate hikes on the revision of GDP, we are still of the view that any interest rate movements or any tightening or loosening of monetary policy affects the economy with a lag. Our estimate is that the lag is between 18 and 24 months. But why didn't you ask the question, was the hike in interest rates responsible for your revision to the inflation outlook, because the inflation outlook has deteriorated? And the answer would have been exactly the same, that these things take place with a lag. Renee, why 25 basis points? I think it was your colleague who asked the question in Davos. And the question was whether the previous hikes are any effective. And the point here was that 25 basis points is not a small amount, given where the policy rate is. But you said, why not 25 basis points? I will ask you, why not 50 basis points? Well, there was a member who initially argued for a 0 increase. Why not the 0 increase then? The point here is that MPC members come into the MPC with views, and after deliberations, we decide which way are we going as a committee, and we have decided to go with the 50 basis points. Patrick, are we frustrated with political leaders? Central bankers are very rational human beings, and so frustrations do not quite enter our decision-making process. As far as the changing of finance ministers is concerned, that question can safely be directed to the presidency. Rashad?
Thank you very much, Governor. Well, I think that you really got to the crux of what our dilemma is. Responding to inflation driven by demand is a rare luxury nowadays. Most of the inflation is coming from the supply side. It is true that discretionary products that we kind of spend on the consumption side is what the monetary policy is most effective in managing. But I think that what the inflation targeting or monetary policy allows us to do is that when we look at supply shocks, I think that we're not responding crudely to an increase in food prices from drought. We're not responding crudely to an increase in prices from the exchange rate. What we're really trying to do is assess what implications these exogenous supply shocks will have on inflation and inflation expectations. And I think that for us, a critical function is to ensure that these supply shocks don't feed into what we nowadays call second-round effects. That you don't have a situation where these supply shocks feed into the way businesses begin to set contracts and so on. And I think that's our most important tool. So it's a tool. It's less blunt for supply-side shocks, more effective when you have direct demand-side shocks, but it nevertheless is an important tool and the only tool we really have. On the issue of agriculture, I mean, that's an important issue. I can't precisely give you a number, but if you look at the revision of the growth forecast from 1.5% to 0.9%, a large part has to do with drought, but agriculture is a small part of the economy, but big changes can have an effect. But the revision, the downward revision in our growth forecast is not only agriculture. It has to do with the further slowing down of the global economy, further slowing down of private consumption, household consumption, as well as a further slowing down of investment. But I think that so it's all embedded in there. But certainly our modelers can give a more precise answer in a different context. Thank you.
Next round of questions, please. Ma'am, in red top.
Good afternoon, Governor. I'm Gelang Bata from Bloomberg. You have said that the rand declined more than expected. If we see further record lows in the currency, could that mean that the rate at which the MPC approaches the tightening of monetary policy will be more aggressive or not?
Sir.
Good afternoon, Governor. Tshepo Mongwai, SABC Radio News. Governor, you've mentioned the issue of the situation where we're experiencing low growth and rising inflation. Can we qualify it as stagflation at the moment? I think that's it for now.
Sir, in a green shirt at the back.
Afternoon, Governor. I'm Funako Toyana from Reuters News. I just wondered, did the MPC discuss a scenario where they see inflation targeting as not an appropriate enough tool, and what sort of monetary tool might they then consider? Were these discussions that you had during the meeting, and can you just take us into your confidence and let us know what the future might look like without inflation targeting? Thanks.
You are aware you are on public TV. Ma'am at the back and here in the front.
Thank you, Governor. Renee again from Bloomberg. Governor, I wanted to know, has the SARB and also the MPC looked at the potential impact of offshore investments that would have to be repatriated because many investors are exceeding their prudential limits after the rand's weakening? Have you looked at what the effect of that might be on the currency and especially the movements in the currency?
Miriam?
Yeah. Do you think this rate hike will have any impact on the capital outflows that we've seen in the past couple of months, the selling of bonds and equities? Do you think that are you hopeful that there will no longer be outflows? And are we still in a rate hiking cycle? You haven't given any indication of that.
I wasn't asked.
Now you're asked.
amogelang. If the rand hits further record lows, will we be hiking more aggressively? We don't target the exchange rate. We target inflation. We only respond to the extent that the depreciation of the currency leads to second round effects and thus prices beginning to rise. That is what we respond to. We do not respond to the depreciation of the currency. The currency is a very important factor in the price formation process, but it is not the only factor. There are other factors that are at play, including the oil price and so forth. Tsapo, do you say, can we, what? Can we? Or are we in a stagflation? No. If you take the strict definition of a stagflation, it would mean that the economy should be contracting and inflation should be running amok. Yes, we can see that inflation is rising, and as a monetary policy authority, we have decided that we must take a stance to make sure that we begin to cap rising inflation. Is the economy contracting? We do not see the economy contracting. We still expect the economy to grow by 0.9% this year. Are we happy with 0.9%? Absolutely not. We would prefer to see growth that will continue to support the job-creating potential of this economy. But such growth is going to require fundamental structural steps to be taken to lift the potential growth rate of the economy. Writers, sorry, I will call you by the house because I couldn't get your name. Have we a scenario where the question was raised as to whether inflation targeting is appropriate or not appropriate? Is that the question?
I'm asking, yes, if you had those discussions of inflation targeting not being appropriate.
Definitely not. Inflation targeting is a monetary policy framework that South Africa has adopted. We have experimented with other frameworks before. We had a monetary policy framework where we targeted money aggregates, so we looked at money supply and credit and all of that, and we thought that that was an appropriate monetary policy framework. It turned out not to work. Without acknowledging it, there was a time when the Reserve Bank gave an impression that it was targeting the exchange rate and intervened extensively in the foreign exchange market. We came out second best. It was not an appropriate framework. There are countries that would have as an anchor of their monetary policies a pegged exchange rate, but then you need very deep pockets to protect the peg. We do not have deep pockets in South Africa. After experimenting with all sorts of frameworks in the past, South Africa decided to adopt an inflation targeting framework in 2000, and the framework itself had been there have been modifications to the framework since then. Many of you might forget, but we used to have something called an escape clause. We no longer have that. We have to explain at every meeting what we see happening to the inflation performance and what we see as the outlook for inflation. We are not inflation nutters. We have implemented the inflation targeting framework flexibly. And over the years, and even now, even when we see that inflation is going to be outside of our target for a persistent period of 2 years, the step that we had taken is still resulting in a situation where the monetary policy stance is actually still accommodative. So we didn't discuss whether this thing is an appropriate framework or not. Renee, the potential impact of was it a potential impact of these rates? Potential impact of?
I wanted to know, after the rand's depreciation, many investors are perhaps exceeding their prudential limits. So the effect of the repatriation of a lot of funds, how that could affect the rand, whether you've looked at that.
Okay, that is something that Mr. Minele likes looking at many times. So I will leave that with him. Miriam, the issue of capital outflows and whether we're still on a hiking cycle. Yes, we are still on a hiking cycle, but as we had said repeatedly, any policy changes that we would take will remain data dependent. The fact that you are on a tightening cycle, if data shows that you should be pressing a pause button on your tightening cycle, you should actually respect that. Would the hike stem the capital outflows that we have seen? If it does, well, great. But we don't target capital outflows. And actually, as an institution, we do not subscribe to the view that for you to attract flows, you must hike interest rates. The reason is that the nature of the flows differ. There are flows that are attracted to a country through growth dynamics, and those tend to be in the equity realm. And there are flows that are attracted by yields and interest rates, and that tend to be the bond flows and deposits. And South Africa has experienced all of those flows. So it would not be an easy proposition for South Africa to say that we are hiking rates in order to stem the outflow of capital. Mr. Minele.
Thanks, Rene. I suspect your question may have to do with comments that we made recently from the bank, which might have been slightly misconstrued to maybe suggest that, we're about to tighten exchange controls and the like. Such is not the case. But in terms of the prudential limits, and as part of the monitoring and the reporting with regards to offshore limits, we tend to operate in a framework which gives some time to institutional investors to sort of rebalance their portfolios when there have been these shifts, which obviously would have not been violations such that people exceeded their limits, but would have come about as a result of valuations and exchange rate movements. Typically, there would be up to a year or so for people to sort of rebalance their portfolio so that there's no sort of abrupt movements and fire sales that could obviously damage people's portfolios as such. So we monitor those limits, and there are certain instances in which some of the institutions may have good reasons why they might need some more leeway in repatriating these funds, and in conversations with those, we then agree with them on appropriate course of action on how to regularize and normalize limits that may have gone over. But it's obviously different from people that potentially could take out fund in excess of those limits, which obviously would be essentially what you would call an active breach as opposed to a passive breach, which you deal with differently.
Webcasts.
Question from Tebeka Semani. Given the fact that most South Africans are heavily indebted, how is interest rate hike helping to reduce inflation when it is going to result in increase on repayment installments as well as increase in the borrowing costs?
Okay.
The second question is from Mervyn. I appreciate your learning from the previous MPC not to intervene directly in the rand, but you said recently that if the market is too unsettled, you may provide liquidity. Do you not think recent moves continue to indicate that, especially as some market talk overseas hedge funds or funds over trading the rand, especially in the thin Far East market?
Mr. Minele, it looks like the second question on provision of liquidity is in your purview. And can one of the two teachers take the question on consumer indebtedness? Brian, do you take that? Oh, there's a new hand right at the back. Yes.
Mandamoto AWN7. Governor, has the MPC assessed the potential impact any electricity tariff increases might have, and has it adopted a position with that regard?
Thank you. Miriam and then Renee.
The rand. Do you think it might remain volatile in the months ahead? You don't normally comment on the direction, but you do say whether you're concerned about volatility. Do you think there is a chance that it might stabilize, as some analysts seem to think?
Renee.
Thank you, Governor. It's just a follow-up on what the Deputy Governor answered to my question. I wanted to know, I understand that, I mean, there's a time in which this money has to come back. It's not an immediate thing. But whether the SARB has looked at the potential impact on the currency of that money coming back to South Africa for investors to be within that limit again. In other words, I mean, firstly, how much money would potentially come back? And secondly, how that could affect the currency?
Okay. You seem to be very popular. Any other questions? Was that the last lot? Thank you. Francois, will you deal with the electricity tariffs? Shall we start? Who are we going to start? Brian, can you deal with this consumer indebtedness and whether we can bring down inflation?
Thank you, Governor. Yes, consumer indebtedness is relatively high, and it does mean that those consumers with floating rate debt will face higher interest cost. Obviously, any new debt will also incur higher interest cost. I think one of the differences between the current rate cycle and previous cycles is that there's relatively more unsecured lending that has been done over the last few years, which is typically done at fixed rates. So the impact on those consumers who had incurred unsecured lending at fixed rates won't be the same as those on floating rate debt. But clearly, it does impact part of the mechanism of raising interest rates to curb expenditure does mean that that new debt will be more expensive, and those consumers with existing debt will pay more.
Yeah, Francois.
Thank you for that question. In the statement we made reference on page 2 that the electricity price assumption remains unchanged from the previous meeting. I think it's somewhere 12.5%. Our approach normally to those type of variables is that we are aware that the electricity utility has submitted an application that is obviously going through the necessary public consultation processes, and eventually NERSA would make a determination. Once they issue such a determination, we would take that into the model, because otherwise we're simply speculating as to the additional increase that may be awarded by NERSA. You would recall, for example, last year they'd also submitted an application, and for a number of technical reasons that was not approved. And so our general approach to these type of issues is that once the number is finalized, we would update the assumptions that are used within the model. So short and sweet answer is the assumption wasn't changed, and we didn't in particular discuss it during this particular MPC meeting. Thank you.
Mr. Minella?
Thank you, Renee. Short answer, I haven't got any numbers that I can give you at this stage in terms of any estimates around that. The second question was around liquidity provision. Just to firstly reiterate what the Governor indicated earlier, we do not target the exchange rate, but we have said previously that if there were to be excessive moves in the foreign exchange market and such that they could potentially threaten the orderly functioning of the foreign exchange market, we obviously would be prepared to provide liquidity and try and stabilize those markets. What we experienced during December were obviously very sharp moves, which were also facilitated by a period of traditionally very thin liquidity conditions in the market. We have been monitoring and looking at developments very, very closely, and the fact that we would have not deemed it necessary to provide any liquidity during that period would suggest that it was not our view that the price discovery mechanism and the orderly function of markets were threatened. But in principle, liquidity provision in exceptional circumstances where the orderly functioning of markets may seem to be in jeopardy remains an option. The issue of whether the rand might stabilize or continue to be volatile, obviously there are a whole host of factors that feed into that. My own sense is that one probably should expect some element of volatility which will not be confined to the rand as such, but have to do with the global and dynamics that we are seeing. There are issues, as we indicated in our statement, around downside risks to global growth and some of the doubts that have arisen as to the strength of the recovery. There continues to be the issue of monetary policy divergence. There are questions around the rate of increases that one might see in the US or the rate of further expansion in terms of asset purchase and quantitative easing programs in Europe or in Japan. All of these things are likely to make for some volatility as we go forward. The issues around commodities, the growth dynamics in China, these are big, big issues that have a bearing on all of us and on currencies. So much as one might not expect huge gyrations that we might have seen more recently, I think an element of volatility given the overall setting is probably likely to be expected.
Thanks. Put simply, the global environment is uncertain, and given this environment that Mr. Minele had just painted out, what you are going to be seeing globally is a realignment of exchange rates, whether they are emerging market exchange rates or advanced economy exchange rates. Before I conclude the proceedings of today, an apology from Deputy Governor Kuben Naidu. He is busy doing what other central banks do, which is to be in Basel and discuss the state of the global economy. He participated in the deliberations over the past 2 days, and so as you would realize, we counted 6 votes. His vote is amongst the 6, so don't think that he didn't participate. That concludes the proceedings of today. Thank you very much. See you in March.